Okay, good evening. This is Professor Mayer. What we're looking at in Chapter 18 is the shareholder or stockholder equity. And again, what we're looking at in the stockholder equity is the wealth of the organization. So you think about assets minus liabilities equals equity. This is the account that we're actually talking about, which is equity. We're going to talk about this from the perspective that there's a number of types of transactions that actually don't flow through the income statement but actually stay in the equity section. And in fact, in the pension class, we talked about these other comprehensive income items, these debits and credits, gains and losses that don't touch the income statement, and essentially are these other items that sort of get hung up in equity. The idea being is that they're not really items that relate to the operations of the organization, so we don't want to confuse investors as they're looking at this information. So that's kind of the deal here, and again, the things that we talked about in the pension is the perfect example. Stockholder equity is what we're looking at here is, again, we've talked about the assets minus liabilities. Assets minus liabilities is net assets, is the equity of the organization. The difference between the debt and equity is debt is the creditor's interest. So if we have creditors, this is the interest of, we have debt, we have creditors, and if we have equity, we have owners. So we always think about the equity represents the wealth of the organization. So as the organization grows and prospers, this wealth increases primarily through the retained earnings, but it's also going to increase based upon contributed capital as the organization invests or issues stock and people invest in the organization. Okay? And again, nothing here that you haven't heard 100 times before. So, okay, so we talked about this is owner's interest represents two primary focuses. The first is the paid-in capital. So as the organization issues stock and owners contribute capital to the organization, in fact, in a small organization, we may not call this stock, but we may call this contributed capital. This is one piece of it, and the other piece of it is retained earnings. Retained earnings is the accumulated earnings of the organization less any dividends that have been paid. So retained earnings is coming from the income statement as net income or net loss. If you don't have retained earnings, you have an accumulated loss. A lot of companies out there that are traded in the public arena have accumulated deficits as opposed to retained earnings, but the idea is that income or loss goes to the equity section as part of retained earnings. Any dividends that are paid are being paid out of retained earnings. This is the ownership interest of the organization. Shareholder equity titles to several alliances: shareholder equity, stockholder investment, shareholder investment, stockholder equity, shareholder equity, shareholder equity. But at the end of the day, it's all the same stuff. What the same stuff is, it's the owner's interest. The two primary categories are paid-in capital and retained earnings. So this is just an example of the equity section. So what you notice here is, I'll just sort of point out a couple of things. Again, nothing here that you haven't seen before, is we have the capital stock. Capital stock includes our common stock. So you notice there's a par value. The preferred stock has a par value of $10. It is cumulative. We'll talk about that. And then what you notice is that there's a lot of categories of paid-in capital, in excess of par for preferred, in excess of par for common, shares repurchased, conversion of bonds, and so forth. And we'll talk about most of those. And then we have the other comprehensive income, or what we call the accumulated other comprehensive income. And again, these are the items. Specifically, we talked about the unrealized gains and losses on pensions. We would also talk related to adjustments from foreign currency, derivatives, and other items. These are things that are truly gains and losses, but the nature of these are such that we keep these out of the income statement. But now they're still transactions, so they still affect the organization. So instead of passing them through the income statement into retained earnings, we simply keep these as adjustments to equity in the equity section, and we call this the adjustments to other comprehensive income. And there are those that would suggest that everything should go through the income statement. We're not here to debate these issues, but we're simply here to sort of explain the fact that some of these items, by definition, are not going to go to the income statement. Treasury stock essentially is the stock of the organization that we purchase back. And we'll talk about this in this discussion today. All interesting stuff. None of this should be a surprise to you. And as we go through this, I think you're going to be fine. Okay. So this is shareholder, again, sort of the continuation of the prior slide. So ultimately what we're looking at is preferred stock, common stock, additional paid-in capital, retained earnings. Retained earnings, again, are the accumulated earnings of the organization from its inception, and it is less any dividends that are paid. So dividends are paid out of retained earnings, primarily. If there's exceptions to this, but in our discussion is these dividends are going to be paid out of retained earnings, and then we have the accumulated other comprehensive income, treasury stock, and otherwise. Okay, so we've talked about this. The primary categories, paid-in capital, consists primarily of invested by shareholders when they purchase shares of stock from the corporation. Retained earnings represents earned capital. So again, what's coming through the income statement is retained earnings. And again, if you look at a financial statement, you don't see the column that says retained earnings, you're probably going to see a number that, or a title that says accumulated deficit, and that simply means that they don't have earnings to retain, but they are retaining a net loss of the organization. Treasury stock, and we'll be talking about this, treasury stock essentially represents the stock that was previously owned and that we bought back by the corporation. And we even could have been buying this back as an investment vehicle, and we may even make a gain on it, but those gains and losses are not going to flow through the income statement. Everything remains in the equity section. Accumulated other comprehensive income extends our view of income beyond net income, reported in an income statement into 4 types of gains and losses not included. And I think we've talked about these. Net holding gains and losses on investments. And what we're talking about here is we're talking about unrealized gains and losses. And these unrealized gains and losses are related to these instruments that we are classifying as available for sale. Okay, so available for sale, you probably remember that from another class. and we talk about how that the gains and losses stays in the equity section. This is where it goes under the accumulated other comprehensive income. Gains and losses from amendments of post-retirement benefits. So this is what we talked about last week, and in fact that problem that I did the video on is there were amendments to the plan, and these amendments to the plan created a liability. That liability stays in accumulated other comprehensive income and then is dispersed to the expense side based upon the remaining life of the participants. But again, while it is depreciated or it's not allocated over to the expense side, that remains here in other comprehensive income. The next piece of this is gains and losses on derivatives and adjustments for foreign currency. We report two attributes of other comprehensive income: components of comprehensive income created during the reporting period in the statement of comprehensive income, and the comprehensive income accumulated over the periods in the balance sheet. So we're basically looking at the change in other comprehensive income, and the change in the other comprehensive income is what took place this year as compared to what was accumulated in the prior year balance sheets. So what we see here is net income, other comprehensive income, the gains and losses on securities, net of taxes. So you notice that all these things are net of taxes. Gains and losses, post-retirement benefit, deferred gains and losses on derivatives, adjustments from foreign currency. So all these things essentially are held in other comprehensive income, but they're held in other comprehensive income net of taxes. So the impact to the equity section is the same whether or not it went through net income, into retained earnings, or directly into equity as these other comprehensive income items. The reason that these items are not flowing through the income statement is there is the belief, and I think in general it's I can't argue with this, is that these do not represent the day-to-day or the year-to-year operations, but are other items that are essentially affecting the organization, the wealth of the organization. Okay, so that's kind of the deal there. Somewhat controversial. I mean, I would think that that's something that some people would say, well, everything should go through net income. Although, as we were talking about last week, is there certain gains and losses related to pensions that if you report these every year, it becomes highly problematic because the pension is such a long period, and year-to-year changes only sort of disrupt the whole process, which is why we did things like the corridor effect and simply allocating a very small portion of significant gains and losses, but we're still reporting everything else. The point is that those items are staying in other comprehensive income as opposed to otherwise. So a corporation, so this is what we're talking about. We're talking about a corporation, and the reason we want to make this point is that we're not talking about partnerships, but a corporation is a separate legal entity. It limits the liabilities to the owners of the corporation. Owners are not personally liable for debts of the corporation. The corporation has a separate legal entity that's separate from the owners. So if the owners die, the corporation continues. It simply is the shares that move from one owner to the next. Shareholders' liability is limited in the amounts that they invest. It's easier to raise capital in this regard disadvantages is that reporting requirements, as well as, and this is primary issue here, and it sort of goes beyond the scope of this course, but we do want to talk about this, is double taxation. What do we mean by double taxation? Is we kind of alluded to the fact that what happens is that as the corporation pays, as the corporation makes money, they distribute this money in the form of dividends to the owner. So the only way you can get corporate income, corporate wealth from the corporation to the owners is through a dividend. Well, the problem with this is the corporation pays taxes. So any income from the corporation is after-tax income. This is what then moves to retained earnings, and then what the corporation does is distribute dividends. So what happens with these dividends is now these dividends are paid to the owners, and the owners then pay tax on the dividend. So the issue becomes that there's this whole concept of double taxation where the income from the corporation is taxed at the corporate level and then the individual level before the owners can actually enjoy the wealth of the organization, which is probably the primary reason why many organizations have moved to a partnership, not public corporations, but smaller organizations. A partnership has its own issues, but the one advantage that it has is that it's a flow-through organization and you're not paying taxes at both the corporate and the individual level. Not-for-profit are types of corporations, could be owned in the public sector by a government unit. Churches, hospitals, and so forth are not-for-profit organizations. Corporations organized for profit may be publicly held, meaning their stock is traded in a public exchange, New York Stock Exchange or otherwise, or privately held only by a single individual or a family or a few individuals, and generally the sale of any stock there is not going to be available to the general public, but is going to be a private sale. Frequently, companies begin as a privately held company and then go public. Okay, common shares. Ownership rights held by common owners include the following things. And again, when we talk about all these rights and so forth, we say in general, because the issue becomes is that in general things change and things may in fact can be limited based upon whatever the corporation says. Okay, so if you buy a stock, what you need to understand is that what you're getting is what you're buying, and whatever the restrictions are based upon what you're buying are your restrictions. But in general, common stockholders have the right to vote. So the right to vote primarily means that they're voting for the board of directors, and the board of directors are there to follow the guidance of the shareholders in terms of leading the corporation. So voting for the corporate directors, the right to share profits when dividends are declared, and the right to share the distribution of assets if the company is liquidated. Preemptive right is the right to maintain one's percentage of ownership when new shares are issued. So in preemptive rights, let's say the shares, outstanding shares are 10,000 shares, and you own 1,000 shares, so you own 10%. Well, let's say the corporation now decides to issue another 40,000 shares, so it's going to go to 50,000 shares. Well, if they issue those shares, your percentage is not going to remain at 10%. But with the preemptive rights is you have the ability to purchase the amount of shares to maintain your percentage. And generally speaking, these preemptive rights are done in such a way that you're buying the stock at a discount, so it's not going to be a significant hardship to the individual. Classes of stock, if more than one class of stock is authorized, there are specific rights for each. So it could be Class A, Class B, and so forth. Could be common versus preferred, capital or otherwise, common or serial preferred. So what we're trying to say here is that the terminology may be different depending upon the organization, but at the end of the day, is all we're talking about is the shares have specific rights. Whatever those rights are, that's what the rights are. Okay, so we talked about the common stock. Common stock has voting rights, has rights when dividends are distributed. They're going to get these. Okay, now let's talk about preferred shares. Rights include one or both of the following. If the board of directors declare dividends, preferred shareholders will receive designated dividends before any dividends are paid to common shareholders. So let's just kind of walk through this. Is they will get designated dividends before, so the key word here is before any common dividends are paid. Now, preferred stock have a preference over common shares as to the distribution of assets. So the idea is that in liquidation, preferred stockholders get their share before anything is distributed to common shareholders. But the key thing here we want to focus on is the designated dividends before any dividends are paid to common shareholders. Now you notice, if you remember 3 or 4 slides that we went back, is the preferred stock was maybe 10% preferred stock, par value $100, whatever the case may be. So the idea is that in preferred stock, what's taking place is that we are paying a dividend, and essentially these are these preemptive dividends that are paid before anybody else, based upon the percentage, and the percentage of what? Well, the percentage of the par value. So it's very important when we look at the preferred stock is to look at the percentage and to look at the par value and obviously the outstanding shares, because that is ultimately what's going to get paid. As we continue here, so I don't think any of this is of a surprise. I think all the stuff that we've been talking about here are the kinds of things that we've talked about before. Okay, so we've got a question. Get the answer in a minute, but if you would like to opine on this is fine. Shareholder equity of FSU Industries include $200,000 of $1 par value common stock, $400,000 par value of 6% cumulative preferred stock. So you notice the term here is cumulative. The board of directors declared a cash dividend of $50,000 in 2016 after paying $20,000 in cash dividends in 2015 and $40,000 in 2014. What is the amount of dividends common stockholders will receive in 2016? Okay, so here's the key. You notice it's cumulative dividends. So the idea is cumulative dividends is the dividends of the preferred stockholders have to be paid up to date before any other dividends are paid. So the idea is we got 6% times $400,000, which is 6 times 4 is what, $24,000, okay? So in 2016, it was $50,000. Cash dividend 2016 after paying $20,000 in 2015 and $40,000 in 2016. So the issue becomes is what is the amount of common stock dividends that shareholders will receive in 2016? B. Okay, so we got B here. Okay, so B is, and again, what we're looking at is So the $400,000 of 6% cumulative stock. So what happened is 50,000 in 2016, 20,000 in 2015, and 40,000 in 2014. So the idea is that in 2014, we had no issue specifically related to the dividends. Okay, 2015, we were $4,000 short. So with $4,000 short is we have to pay up. So the idea is pay up and make it even Steven before you can pay anything out. So in 2016, the preferred stockholders get $24,000 plus the remaining $4,000 from 2015, which is $28,000, and that's 28 minus 50. Take 28 from 50 gives us 22,000. So B is the answer, and I did that in my head, which is amazing, but I couldn't have done it without having the answer right there. Okay, cumulative preferred. Cumulative preferred means that you have to get up to date with your preferred stock before any other dividends are paid. So just kind of going through this is what we're looking at is what is paid to common shareholders in 2016. So 2016, we have $50,000, and we subtract from that 6% times 400, which is 24. Okay, so that's for 2016. So that gives us 26. Now the issue becomes is if you look at 2005, $20,000 of dividends were paid, which means that the preferred stockholders were shortchanged by $4,000. So we need to pay that additional $4,000 from 2015. So what's left is 22,000. So I did that with my mouse and a little sloppy, but I think you get the point. So that's the answer there. The next question is it equity or is it debt? So part of the issue is that there's a number of securities that are issued that we call basically hybrid securities. They're kind of a cross between equity and debt. Sometimes they have convertibility features. Whatever the case may be, is the issue becomes is that we have people are buying debt, but it's easily convertible into equity or something to that effect. So preferred stockholders receive dividends each year. The company pays dividends. So one of the things that one could argue is that preferred stock actually sort of works and acts like debt. The difference is that preferred stock still has that whole issue of the fact that it is not a deductible expense to the organization, so it's paid in after-tax income, but it sort of kind of works like that in the sense that you got to pay it before any of the common stock dividends are paid. So in fact, when we start looking at things such as free cash flow and other issues, we actually consider these preferred dividends as part of the expenses that we pay before we consider what else is available for our common stockholders. So equity is, it's called equity. Preferred shareholders receive dividends each year. The company pays dividends. So the issue with preferred stock is that if you can't pay it, it's okay. You may have to make it up in future years, but you're not at risk. Debt, you got to pay. You have the obligation to pay cash or other assets at a fixed or determinable rate in future markets. Now, there's a mandatory redeemable preferred stock, must be reported on the balance sheet as a liability and not as shareholder equity. So the idea is that if you have to pay the dividend, it's going to be debt and it's not going to be equity. Debt is you got to pay it. You absolutely have to pay your bills or people or bondholders get really, really angry. So Let's kind of shift the discussion a little bit over. We're going to talk about par value. Most shares continue to bear an arbitrary designation as par value. Shares with a nominal par value become common to dodge the elaborate statutory rules pertaining to par value. So the idea is that the par value is part of the state requirements related to the establishment of the organization. The issue related to par value is that if the market value drops below par value, it creates a very complicated situation, sort of beyond the scope of this course, but we don't want that to happen. So in most cases, organizations will establish a par value, which is the legally established value of the stock, at a very, very, very low level. It might be a penny, it might be even less than a penny. But it doesn't matter, because this has nothing to do with anything other than the fact that it separates the transaction into two elements. The transaction is common stock. Common stock is the par value. No, par value is actually not always $1. It could be much less than $1, could be less than a penny, or it could be greater than $1. For our purposes, $1 kind of works because it's easy, but $1 is not necessarily the case. Okay, so Dow Industries sells 100,000 shares of its common stock of $1 par value for $10. So you notice that the transaction is separated between common stock, which again is the par, so this is the par, okay, I can't write with my with my iPad or my mouse here, but you get the idea. So this is the par. So that's $100. So $100 is $1 times 100 shares, and it's in thousands. Okay, so it's 100. But we sold it for basically $1 million. So everything else goes into paid-in capital in excess of par, or it could be called additional paid-in capital, or as some accountants will call it, is APIC. Essentially what this means is this is the plug number between the number of shares times the par value, and the difference of that from the cash. The cash that was collected is, in this case, $1 million. And, well, that's basically the premium is the par value. Okay, so the par value is, or the paid-in capital in excess of par. So in this case, what we see here is that the stock was sold for $10 a share, where in fact the par value is only $1. So the premium associated with this is the $9 per share. And premium is probably not the right word, because it's not like as if we're selling it for more than it's worth. We're selling it for exactly what it's worth. But the idea is that we're selling it for more than the common stock. Now, premium, to your point, is more associated with bonds when we're selling the bonds for greater or less than par value, which is which has nothing to do with the paid-in capital in excess of par. Okay, so just make sure that we understand that. Premium, you could make a case that you want to kind of at least include premium in the calculation related to preferred stock, but for common stock it really is not an issue. It's not really a term that we would use. And again, premium is more associated with bonds. If you issue stock in a state that doesn't require a par value, you essentially are issuing a stock. Everything is going to go to common stock, and you're going to see that. Now, consider this, is let's say we issue stock for non-cash consideration. A company might issue its shares for consideration other than cash. That is, maybe to sell for promotional or legal fees, or shares may be given in payment for land or for equipment, or for some other non-cash asset. There's a great story maybe a couple years ago related to when Facebook was just beginning. It was just kind of a twinkle in the eye of the owner, and they needed some painting done in the offices. They didn't have any money, so they told the person that painted the offices, "We're not going to pay you. We're just going to issue your stock." So they were issuing the stock that essentially ultimately proved to be extremely valuable, but at the time it was not necessarily so. Okay, so the idea is if we issue stock for non-cash consideration, the question becomes is how do we actually record this transaction? And the issue becomes is we have two variables. We have what we're paying for, whether it's an expense or it's an asset, and then we have the value of the stock. So the issue becomes if we know the value of one, but we don't know the value of the other, that's what we're going to go for. We're going to use, okay? So the issuance of shares should be recorded at fair value. So the best evidence of fair value might be the quoted market price of the shares, a selling price established in a recent issue of shares for cash, the amount of cash that would have been paid in cash for the purchase of the asset or services, or an independent appraisal of the value of the asset received, or other type of evidence. So the idea is that, let's say you bought a building. So the building, the fair value of the building is $1 million. You issue stock for it. You don't know how much the stock is valued for. Therefore, the transaction is recorded at $1 million because that's fair value. Let's say you purchased an intangible asset that's very hard to determine what the value of it is, but you know the market price of the shares. Therefore, you would use the market price of the shares. If you know the market price of the shares and the market price of the asset is essentially you use the lower of the two because you would assume that you're getting some sort of discount associated with this. Okay, so those are the sort of the variables that we need to consider when we're looking at non-cash transactions. Dumont Chemicals issues 1 million of its common stock of $1 par value in exchange for a custom building for which no cash price is available. Today's issue of the Wall Street Journal lists Dumont stock at $10 per share. So essentially what we're looking at is we're saying we're issuing this transaction at $1 million because we don't know the value of the asset, but we do know the value of the stock. Okay, it seems like a kind of a bizarre transaction. So this is what we're going for. So it's a million shares, $1 million. So we're reporting this at $10 million. Common stock is going to be $1 million. Paid in capital in excess of par is 9. And we're basing this based upon what we know, and what we know is $10 per share. Here's another quick question. When stock is issued in exchange for property, the best evidence of fair value might be any of the following except the appraised value of the property received, the selling price of the stock in a recent transaction, the price of the stock quoted in the stock exchange, or the average book value of the outstanding shares. So any want to take a gander at what this answer is? I've got a couple of D's. I'm leaning towards D. I've got a B. Selling price of the stock. Let's see here. Here it comes, and it goes to D. Okay, so the idea is if you know what the prices of the stock is selling for, that's good. That's good enough. Doesn't have to necessarily be today, but a recent transaction. The key word is recent transaction. If it said transaction 10 years ago, that's probably of no value. Book value really has nothing to do with market value. and fair value. Book value basically is the assets minus liabilities divided by outstanding shares. So you're looking at book value from a very accounting perspective that has no sort of relevance to market value. So D is the answer basically for that reason. Continuing on here, this is all fun stuff. So occasionally shares are issued for consideration other than cash, maybe services or a non-cash asset. In those instances, transactions should be recorded at fair value of the shares of the non-cash consideration, whichever seems more clearly relevant. This is consistent with the general rule of accounting for any non-cash transaction. Now, this will probably be the, well, we'll see how far we get. This is kind of fun. So here we're going to sort of look at sort of a pro rata distribution of our cost associated with distributing a sales price based upon 2 or more securities. Okay, so the idea is, let's say we issue preferred and common stock in a bundle and at a single price. Or we issue the common stock and a stock warrant at a price. Or maybe we issuing bond and a stock at a price. Okay, so it's a more than one security at a single price, and what we're looking for is we're looking for the distribution. So in this case, what we're looking at is APNP issues 4 million of its common share, $1 par value, and 4 million of its preferred shares, $10 par value for $100 million. Today's issue of the Wall Street Journal lists common stock at $10 per share. There is no established market value for the preferred stock. So what do we know? Well, we know what we issued it for. We issued it for $100,000. So that's what we see right here. So the issue becomes is what else do we know? Well, we know the only thing else that we know is that the common stock is $10 per share. And we issued 4 million shares. So if that's the only thing that we know, then that's what we're going to go with. Keep in mind that these shares are $1 par value stock. So everything is going to go to paid in capital in excess of par. And let's see where we go here. So what you see here is 4 million times 10 is 40 million. But 4 million at $1 is going to be par value of 4. So this is the 4 here. This is relating to $1 par value. 36 plus the 4 is related to the market value of 40. See if I can do the 40 there. And the 40 is $10 times 4 million. So we got a 40. So if a 40 is here, then the only question is what is the plug number? Well, we know that the plug number is going to be preferred stock of $10. And, oh, sorry, it was actually, this is the 4 million common stock and 4 million preferred stock. Okay. So we continue this here, and what we see is 10 times 4, yeah. 40, 10 times 4 is 40, and then the remainder is going to go to paid in capital in excess of par. Okay. The other point that I want to make here is dividends on preferred stock are paid based upon par value. Go back over here and just make this point here. So it doesn't say what the dividend is on the preferred stock, but the point is that it's paid based upon the $10 par value. So in general, the preferred stock is going to have a significantly higher par value than common stock. And again, the reason this is because the preferred stock is paid, you get a dividend, and the dividend is based upon the par value. So generally speaking, you're going to see something like this where you have a preferred stock with a $10 par value. It's by a percentage, and the missing variable here is what is the percentage. So if it's a 10% $10 par value stock, is the dividend, whether it's cumulative or otherwise, is 10% of the $10. So the percentage is based upon the whatever the preferred stock is, which is not given in this. But again, I wanted to make the point related to the fact that common stock, very, very low par value because of the reasons that we talked about. The preferred stock has a much higher par value, but usually in denominations where the calculation of the preferred dividend is pretty easy to make. And then the dividend, if it's 4% par value, $10 par value stock, you're going to get 4%. So there's two par values, the $1 par value and the $10 par value. You get 4 million of common, 4 million of preferred. So you notice here, and then the other issue is the fact that we do know the price of the common stock, which is $10. So the price of the stock is $10. $10 times 4 million is 40 million, but only 4 million times 1 is 4 million, and the rest is going to be paid in capital in excess of par. So the difference is the 60 million, and that's where you want to allocate to the preferred stock. Shares issued at cost reduce the net cash proceeds from selling the shares and thus paid in capital in excess of par. So let's see what reduce the net cash proceeds from selling the shares and thus paid in capital excess of par. Okay, so the idea is that what we're looking at is whatever we receive, the common stock is going at par value, everything else is going to paid in capital in excess of par. Beginning our discussion related to treasury stock. So treasury stock is this wonderful phenomena. Wonderful phenomena is the fact that we have all of these outstanding shares. So the outstanding shares, these have been issued, and then we buy back some of these outstanding shares. Well, we may buy back these outstanding shares because we want to distribute these to employees because of a way to distribute profits without paying dividends. We may want to buy back these shares to decrease the supplies of shares in the marketplace. So buying back these shares may be a way of increasing the overall price per share. Acquisition of companies' own assets. But here's the point that we want to make, and I want to kind of focus on these buybacks, and again, what we're talking about here are treasury stock. When we buy these shares back, we do not create an asset. If we were to buy, if we as a company were to buy someone else's shares, these would be an investment in the balance sheet, in an investment account, and then any gains and losses would be reported in either other comprehensive income or the income statement, okay? But if we buy our own shares, is what this is doing is this is reducing, obviously reducing cash, so it's a credit to cash, but the debit is going to go to treasury stock, and treasury stock remains as a debit in the equity section, and essentially reduces the wealth of the organization. So acquiring our own stock is a transaction that stays within the equity section of the balance sheet. Okay, so I'm going to focus on how to account for these, and how to account for these is where we are creating an account of treasury stock. If we retire the accounts, we're essentially reducing the amount of issued shares and reducing additional paid-in capital, and we're done with it. When we buy back the shares as treasury stock, everything stays the same in our common stock and additional paid-in capital, but we have this offsetting account, which is a debit account that we call treasury stock. Now, let me just make a point related to definitions. So we talk about issuing stock. So issuing stock is the amount of stock that is sold. But we also use this term of outstanding stock. Outstanding stock is what we've sold minus treasury stock, which becomes important because what we talk about when we talk about a dividend is we don't pay ourselves a dividend. We're only paying a dividend to outstanding shares. So outstanding shares, in other words, what we sold minus treasury stock, becomes sort of the number that we work with when we're looking at the dividends that we're paying. So here's an illustration. American Semiconductor balance sheet includes the following items. So we have common stock. We have 100 million shares at $1 par. We have paid-in capital in excess of par, paid-in capital shares repurchased 2, and retained earnings of 2,000. Case 1, we repurchase the shares at $7. If we're retiring the stock, basically, and again, not necessarily we're going to focus on this a lot, but essentially what we're doing is we are reducing our par value and reducing our paid-in capital, and then at whatever it is, so this is the original price, any difference is going to go to the share repurchase. If we have other plans for it and we're not retiring it, we simply create an account that we call Treasury Stock, and this is at cost, and this stays essentially as an offsetting account in the balance sheet. So you notice that Treasury Stock is a debit. So a debit is going to reduce the equity in the balance sheet. So we reduce the common stock and paid-in capital based upon the paid-in capital price of $9, and then the excess is going to go to the this account that we call the paid-in capital share repurchase. So this basically concludes where we are in this discussion. We're going to continue this. We have a lot more to talk about in this session. I thank you very much for your time and attention, and we will continue this in 2 weeks. And I thank you very much, and everybody have a great evening. Okay, thanks a lot. Okay, bye-bye.